Bismillahirrahmanirrahim. This is the sixth video on financial statement analysis. And in this video, we will discuss a case on effect of industry economics on balance sheet. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us discuss a case on effect of industry economics on balance sheets. So the case is that we have to assess the investor relations or corporate information section of the websites of American Airlines, Intel, and Disney. We have to study the business strategies of each firm, examine their financial ratios below that are given over here, and indicate which firm is likely to be American Airlines or Intel or Disney, and we have to give the reasons for that. So, first of all, let us look into the similarities in business strategies of the three firms. So, despite operating in vastly different industries, American Airlines, Disney, and Intel share some similarities in their business strategies. And let us look into the diversification of revenue streams. Now, American Airlines, they diversify revenue through passenger tickets, cargo services, etc. Disney, they diversify their revenue across movies, theme parks, merchandise, TV network, etc. Intel diversifies revenue through CPUs, data center processing, etc. Then focus on technological innovation. Now, American Airlines innovates in fleet optimization, customer experience, enhancements like in flight entertainment and operational efficiency. Disney innovates in content creation, example like movies, TV shows, theme park attractions, and digital streaming technology. Intel innovates in semiconductor technology, including CPU architecture and integration of new technologies. Then American Airlines, they operate globally with domestic and international flights serving a broad customer base. Disney has a global presence with theme parks, media networks, and content distribution. Intel sells products worldwide serving diverse industries such as technology, telecommunications, and automotive. Then American Airlines focuses on improving passenger comfort, service quality, and loyalty programs to enhance brand reputation. Disney, there is strong brand management with iconic characters, immersive experiences, example theme parks, and high quality content to build customer loyalty. Intel builds trust through reliable, high performance products, customer support, and partnerships with technology developers. Coming to corporate social responsibility, American Airlines engages in corporate CSR, corporate social responsibility through environmental sustainability efforts, community involvement, etc. Disney emphasizes CSR with environmental stewardship, ethical business practices, and community engagement. Intel prioritizes CSR with sustainability goals, ethical standards in manufacturing, etc. Then American Airlines, they collaborate with other airlines through alliances, example One World, and code share agreements to expand network reach. Disney partners with other studios, content creators, and tech companies, example Pixar. Intel collaborates with OEM systems integrations and integrators and software developers to optimize product integration, innovation, and market presence. Then American Airlines adapts to changing travel demands, economic conditions, and regulatory changes to maintain competitiveness. Disney responds to shifts in media consumption habits, technological advancements, and global entertainment trends to stay relevant. Intel adjusts strategies based on technological advancements, market demand for semiconductors, etc., to sustain leadership. So these similarities, they highlight their shared emphasis on innovation, diversification, customer centricity, global operations, and responsible corporate practices to drive growth and maintain leadership in their respective industries. Next, let us look into the differences in business strategies of these firms. So, despite some similarities, American Airlines, Disney, and Intel also differ significantly in their business strategies due to their distinct industries and market dynamics. Let us look into the difference. American Airlines primarily operates in the airline industry, focusing on passengers and cargo transportation services. Its revenue comes from ticket sales, cargo fees, and ancillary services. Disney operates in entertainment and media industry including movies, TV networks, theme parks, etc. Revenue streams are diversified across entertainment segments as far as Disney is concerned. Regarding Intel, it specializes in the semiconductor industry, manufacturing and selling microprocessors, data center processors, and other semiconductor products. Its revenue is derived from sales to technology company and consumers. Then coming to technological innovations and research and development, American Airlines innovates in fleet optimization, customer service enhancement, and operational efficiency. Disney innovates in content creation, theme park attraction, and digital streaming technology to enhance entertainment offering and customer engagement. Intel focuses on semiconductor technology innovation, including advancements in CPU architecture, process technology, and integrating of new technologies. It invests heavily in research and development to maintain leadership in the semiconductor industry. Then American Airlines operates primarily through air routes serving domestic and international destinations. Disney has a global presence with theme parks, media networks, and content distribution, catering to diverse international markets and adapting content to local preferences. Intel sells semiconductor products globally, serving various industries including technology, telecommunication, and healthcare, even automotive. Then American Airlines focuses on enhancing passenger comfort, service loyalty, loyalty programs, and operational reliability. Disney builds a strong brand loyalty through iconic characters, immerse theme park experiences, high quality content production, and customer engagement across entertainment platforms. Intel maintains brand through reliable, high performance semiconductor products, customer support, and partnerships with technology developers and manufacturers. American Airlines engages in CSR initiatives focusing on environmental sustainability, community involvement, and diversity with the airline industry. Disney prioritizes CSR efforts including environmental stewardship, ethical business practices, and community engagement across global operations. Intel emphasizes CSR through sustainability goals and ethical manufacturing practices. Then American Airlines collaborates with other airlines through alliances and code share agreements to expand network reach and improve operational efficiency. Disney partners with studios, content creators, tech companies, and global distributors to enhance content offerings, expand market presence, and leverage intellectual property rights. Intel collaborates with system integrators and software developers to optimize product integration, drive innovation, and enhance competitiveness in semiconductor technology. So each company tailors its strategies to capitalize on its respective industry, strengths, market opportunities, and customer demands while navigating distinct operational challenges and regulatory environments. Next, let us look into the value analysis of these three firms. And let us talk about a comparative value analysis of American Airlines, Disney, and Intel across some key dimensions. First, being the financial performance. Now, American Airlines relies on passenger revenue and is sensitive to economic cycles and fuel costs. Profit margins can fluctuate due to operational expenses and regulatory pressure. Disney, they have revenue from movies, theme parks, merchandise, media network, and streaming, etc. It has a strong profitability driven by popular franchises and global entertainment appeal. Intel generates revenue mainly from semiconductor sales, including CPUs and data center processors. Historically, they have strong profitability due to technological leadership and semiconductors. Then American Airlines competes in the airline industry by focusing on expanding its network reach and enhancing operational efficiency. It faces competition from both major airlines and low cost carriers, but strengthens its market presence through global alliances and partnerships. Disney dominates the entertainment sector with a vast portfolio including Marvel, Star Wars, and Pixar. However, it faces competition in streaming and companies like Netflix and Amazon and in theme parks from Universal Studios. Intel leads in semiconductor technology with a significant market share in CPUs and data processors. It competes with other semiconductor giants like AMD and Nvidia by focusing on innovating and technological advancements. Coming to strategic initiatives, American Airlines focuses on optimizing its fleet, improving customer experience, and forming global alliances to foster growth. Additionally, the company invests in sustainability initiatives and operational efficiency improvements. Disney emphasizes creating content and develop franchises. Additionally, the company innovates in theme parks, experiences, and immersive entertainment to attract a global audience. Intel drives innovation in technologies while expanding beyond CPUs and emerging markets. The company also ventures into autonomous vehicles and maintain technological leadership through substantial investments in research and development. The challenges for American Airlines is it faces vulnerability to economic downturns, fuel price fluctuations, and regulatory changes that impact its operations. The company strives to maintain customer satisfaction and operational reliability amidst intense competition in the airline industry. Disney is adapting to digital disruption in streaming while managing operations during global crises that affect theme parks and content production. The company aims to balance investments in new content with maintaining profitability and leadership in the entertainment market. Intel faces intense competition in semiconductor technology, especially in AI and GPU sectors. The company also manages complex global supply chains while innovating to meet diverse customer demands across various technological fields. To conclude, American Airlines, Disney, and Intel exhibit distinct strengths and challenges shaped by their industries, market positions, and strategic directions. Each company focuses on leveraging strength in operational efficiency, innovation, and market expansion while addressing industry specific challenges. Understanding these dynamics help evaluate their relative value and strategic positioning within their respective markets, guiding opportunities for growth and strategic adaptation. So, once we have talked about the similarities, differences, and the value analysis, now we are in a position to answer the case and let us look into it. Now, Intel, as we have seen, faces significant risk due to rapid technological changes in the semiconductor industry. So, as a leader, Intel must constantly innovate to keep up with advancements in technologies and emerging fields like 5G. Their ongoing innovation is crucial as it can quickly render current products obsolete or less competitive. Additionally, semiconductor manufacturing is capital intensive, requiring substantial investments in equipment, facilities, and research. So, this capital intensive nature underscores Intel needs to maintain strong financial health to support its technological leadership and market position. The distinction between financial and business risk is important here. Now, while financial risk relates to Intel's ability to manage its financial obligations and investments, business risk encompasses broader challenges such as market demand, competition dynamics, and technological advancements. So, looking into the figures, Intel is identified as firm B. Now, both American Airlines and Walt Disney are exposed to cyclical risk due to the nature of their revenue streams, which fluctuates with economic conditions. American Airlines revenue is primarily derived from ticket sales, cargo services, and ancillary services. Fees related to passenger travels, we have already talked about that. Now, these revenues are highly sensitive to economic factors such as consumer spending power, business travel demand, and overall economic growth. So, during economic downturns, consumer and business travel tends to decrease, impacting American Airlines revenue negatively. This cyclical nature makes their revenue streams unpredictable and subject to economic volatility. Walt Disney generates revenue from a diverse range of sources, including movies, theme parks, merchandise sales, media networks, and streaming services. Similar to American Airlines, Disney revenue is influenced by economic conditions. For instance, theme park attendance and consumer spending on entertainment products can decline during economic downturns. Changes in economic conditions can affect Disney's revenue stream differently. For example, during economic downturns, consumers may cut back on discretionary spending such as theme park visits or purchasing merchandise, impacting Disney's overall revenue. Then, use of long term debt. So, given the cyclical nature of their revenues, both American Airlines and Walt Disney may adopt conservative financial strategies regarding the use of long term debt. Long term debt is typically used to finance investments and expansions. However, during economic downturns, when revenue streams are uncertain or declining, taking on additional long term debt can increase financial risk. Therefore, both companies may prioritize maintaining lower levels of long term debt to mitigate financial leverage and ensure financial stability during periods of economic volatility. To conclude, the cyclical nature of the revenue streams due to economic conditions necessitates that American Airlines and Walt Disney carefully manage their financial strategies. By reducing reliance on long term debt, they aim to strengthen their financial resilience and mitigate risk associated with economic downturns impacting their revenue streams. Disney operates theme parks as part of its business alongside producing movies and family entertainment. However, in its financial reporting, Disney does not classify theme parks under property, plant, and equipment. Instead, theme parks are typically categorized separately as part of Disney parks, experiences, and product segment. So, here is why this matters. First is the financial reporting impact. Now, property, plant, and equipment typically include tangible assets such as building, machine, and equipment that are used in operations and have a long term useful life. These assets are capitalized and depreciated over time. By not including theme parks under property, plant, and equipment, Disney effectively reduces the proportion of its total assets attributed to property, plant, and equipment on its balance sheet. This can impact financial ratios and metrics that investors use to assess Disney's financial health and operational efficiency. Then another argument is the segment reporting. Disney theme parks are a significant part of its operations and revenue streams. They are reported separately under the park experiences and product segment in Disney financial statements. This segmentation allows Disney to provide clearer insights into the financial performance and operational dynamics of its theme parks. Separate from other aspects of its business, such as movie production or merchandise sales. Strategic and financial considerations are there, like managing theme parks separately from property, plant, and equipment enables Disney to allocate resources, track expenses, and assess profitability more accurately within this specific segment. It reflects the unique nature of theme parks as experiential attractions that require ongoing investment in guest experiences, attractions, and infrastructure rather than typical fixed assets under property, plant, and equipment. So, in summary, Disney decision not to include theme parks under property, plant, and equipment in its financial reporting reflects a strategic and practical approach to segmenting its business operations. This approach helps Disney provide more detailed and relevant financial information to stakeholders. while accurately reflecting the unique characteristics of its theme park operations. So the figure reflect that firm C as that of the capital structure of American Airlines and firm A that of Disney. And the arguments are like assets. American Airlines primarily holds flight and ground support equipment as its major assets. Now, these assets, such as aircraft and support vehicles, have a ready market. If the airline defaults on its loans, the lenders can repossess and sell them. The relatively high liquidity of assets reduces the risk for lenders, thereby lowering borrowing costs for American Airlines. In contrast, Disney's assets include a diverse range of holdings such as intellectual property, theme parks, and other entertainment related infrastructure. These assets are more specialized and may not have a readily available markets compared to airlines equipment. As a result, lenders may perceive higher risk in case of default, potentially leading to higher borrowing cost for Disney. Then financial performance and debt ratios. Now, American Airlines has experienced net losses over several years, leading to negative shareholders' equity in some periods. Now, negative shareholders' equity occurs when a company's liabilities exceed its assets, reflecting financial distress or sustained loss. So, due to these financial challenges, American Airlines may rely more heavily on debt financing to fund its operations and cover losses, resulting in a higher ratio of long term debt to assets. So, this ratio indicates the proportion of a company's assets financed by debt rather than equity. Conversely, Disney has historically maintained stronger profitability and positive shareholders' equity. This financial strength allows Disney to access capital markets at lower cost and maintain a lower debt to assets ratio compared to American Airlines. Coming to the impact on capital structure, the higher long term debt to assets ratio for American Airlines reflects its operational challenges and strategic reliance on debt amid financial losses. The higher ratio indicates that a greater proportion of the company assets are financed through debts, which can increase financial leverage and risk. For Disney, a lower debt to assets ratio signifies a more conservative approach to capital structure management. The company's stronger financial position and diverse revenue streams enable it to support growth and operations, with less reliance on debt financing, contributing to lower borrowing cost. So, in conclusion, while American Airlines benefits from lower borrowing costs due to the liquidity of its aircraft and equipment, its higher long-term debt to assets ratio reflect financial difficulties and operational losses. In contrast, Disney's lower debt ratio reflects its stronger financial performance and broader asset base, allowing for a more balanced and conservative capital structure. So, this completes the sixth video on financial statement analysis. I hope you have enjoyed the presentation, and if you found value in this video, then please like, subscribe, and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.